Good afternoon, ladies and gentlemen, and welcome to the latest installment of the Option Industry Council's webinar series. My name is Mark Benzequin, and I'm a staff member here at the OIC. We're glad that you can join us to learn more about options as a flexible and powerful trading tool. In our webinar today, Volatility Spreads, Trading High and Low Vol, we'll discuss risk, potential payoff, and break-even points of high and low volatility strategies. And as always, we'll cover the material and your questions in a quick 60-minute session. Additionally, our previous webinars can be viewed on the OIC YouTube channel. That being said, ladies and gentlemen, I'd like to introduce you to our presenter today, Mr. Bill Ryan of OIC and the NYSE. Bill began his career in options in 1982, and in his current role with the NYSE is responsible for business development and sales, as well as heading up the NYSE's options education effort. So without further ado, Bill Ryan and today's topic, Volatility Spreads, Trading High and Low Vol. Bill?
Thank you, Mark, and thank you everyone for taking time out of your busy day to come in and hear what we have to say. So let's get started right away. Let's talk about the Option Industry Council first, and we'll talk about a risk disclosure document that's up here right now. And anybody that's ever been to one of our seminars or attended one of our webinars has seen this. And a couple of things on here we'll cover briefly. The first paragraph, we tell you that options involve risks that are not suitable for everyone. And that's true, but options are a great tool, and it's something that every individual should learn and know how to use. And you should learn how to know and use at least one or two bullish strategies, bearish strategies, and neutral strategies. But if you're not willing to put the time and effort into it, options are not the kind of a strategy, buy and hold, and forget about it, go on vacation, and not pay attention. You have to pay attention to the options world. The other thing we talk about here is that we don't use commissions, fees, margin interest, and taxes in any of our examples, and that makes the math simple for me as well as for you. Okay, so the Option Industry Council and who we are. Well, the Option Industry Council is a partnership of the Option Clearing Corp, the OCC, and the options exchanges. And our goal is to provide free and unbiased education about the benefits and risks of exchange-traded options. And here's who we why do we have two of those? Here's who we're made up of. It's the options exchanges. Right now we have 14 exchanges. We have 6 options exchange groups. So, for example, NYSE, who I work for, we have 2 options exchanges. The CBOE has 2 options exchanges. NASDAQ now has 6 options exchanges. So there are 14 different options exchanges owned by 6 exchange groups. And here's why you should be interested in the options world, and here's why it's a great tool for everybody. Take a look at around 2003, 2004. Look at that growth in the option business. It's unbelievable how many people have started using options. And that's just not institutions. That's individual investors such as yourselves. And, around 2000 is when the ISE came in. And, a quick history lesson here is that's when multiple listings started. But when you look into 2003, 2004, 2005, that's when we started getting more institutional interest. We started getting ETFs and options on ETFs. And look at the growth that we've had. We had a great year in 2010, or 2011 rather that was. We came down a little bit, but we came back up again, and we're having another good year this year. So let's talk about tonight. We're going to look at implied volatility and the effect on option strategies and prices. We'll talk about long straddles and strangles. Short straddles and strangles we'll talk about briefly. Backspreads, we'll show you an example of a call backspread, and then we'll have a conclusion where hopefully we'll have time for questions and answers. And as Mark said, just if during the presentation, type your questions in, and we'll see how many of them we can get to during the at the end of the presentation. And if we don't get to all of them, then Mark, who's one of our staff on the investor help desk, will answer those questions, or there's another Bill Ryan that can answer them. But you will get an answer to you. Okay, implied volatility effect. But first, let's explain what implied volatility is. For those of you who don't know, implied volatility is the volatility that's derived from the current trading price of an option. So it's not coming from the stock directly, it's coming from the market, from the options marketplace. And if you were to take an option pricing model and put all the numbers into the model except for the volatility, and instead of volatility, you entered a price where you saw the option trade, that would return the implied volatility. So that tells you what the market says the volatility of that option is right now at this point. A lot of people look at implied volatility as future volatility as well, making a prediction of what the volatility will be in the future. So implied volatility is the volatility derived from the current market right now. That's market makers, professional traders. That's individuals such as ourselves that put trades into the marketplace. That's where we get the implied volatility from. So here on slide 8, we tell you that at expiration, an option's worth is the intrinsic value only. And that's very true because implied volatility affects the time value. And we know at expiration, an option will be in or out of the money. There's no time left. So at expiration, implied volatility doesn't mean anything. But leading up to expiration is where implied volatility comes in. Changing volatility may help you make a decision about what to do with the trade. If volatility increases, you may decide to take that profit earlier than you did before. If volatility decreases, you may decide that you want to get out of the market earlier than you thought before. If volatility decreases, you may be making more money than you were before. So implied volatility is kind of funny. It's something you have to pay attention to, something that has a big effect on option prices. So any long call or long put position is looking to take advantage of implied volatility. And any short call or short put position is looking to take advantage of a decrease in implied volatility. And simply stated, that means that as volatility increases, option prices generally increase. And as volatility decreases, option prices generally decrease. Now, volatility, as you know, is not an indicator of direction. Not an indicator of direction. It tells you it's a measure of risk. So it tells you that some position may be more risky than another one. But in general, generally speaking, if volatility goes up, option prices increase. If volatility goes down, option prices decrease. Now, the last bullet on the slide, we tell you that the effect of changing implied volatility varies with complex strategies. So what we're telling you here is that if you do a spread, and I hope many of you are familiar with spreads, if you do a spread and you have a long and a short, you may have an offset in volatility because an increase will help your long side but will hurt your short side. So we're telling you that you have a spread, volatility changes, you could have an offset there. So strategies that want implied volatility up, long straddles and strangles. You're buying two options. You're buying a call, you're buying a put. If you're buying, you want that increase in volatility. So we're looking for an increase in volatility to raise option prices so that they're above what we paid for them. If implied volatility doesn't increase when we do these strategies, we may need a big movement in the underlying stock. Now, backspreads, either call or put backspreads, involve buying more options than we're selling. So we have more on the long side. So we want that increase in volatility so that those long options increase and the short options, will hurt us a little bit, but it won't hurt us as much because we have more on the long side than on the short side. Now, we tell you at the bottom here that these strategies carry limited risk. Anytime you're long a straddle or you're long a strangle, the most you can lose is the premium that you pay for that straddle or strangle. And with the backspread, if you're doing it, as any spread, spreads have limited risk. So we'll explain the backspread in a little bit, but with any spread, you have that limited risk factor. Okay, so let's talk about first a long straddle. So we're going to buy a call and buy a put. Both are going to have on the same stock, the same strike price, the same expiration month. And again, we're looking for an increase in volatility. All right, we expect a significant move in the stock. Take a look at that little graph over on the right-hand side, that long straddle. You see that V? Take a look at that and think about that for a second. We're going to explain that a little bit further on, but that's a great representation of what a straddle looks like. So our example here is that we have XYZ stock is currently at $50. We're going to buy the January 50 call. We'll pay $3.20 for that. We'll buy the January 50 put. We'll pay $3 for that. That's a net cost of $6.20 or $620. Now, look at this again. buy the January 50 call, buy the January 50 put. We have two rights. We have the right to buy the stock at 50. We have the right to sell the stock at 50. What do we expect is going to happen here? Well, we really don't know, right? We expect something big to happen, but we're not sure if the stock is going to go up or going to go down. So we're going to buy the straddle looking for a big move in the stock. All right, so we're going to fill in the table here, and I'm going to fill a couple of prices in as we go. Now, we have two break-evens here because we have a call and a put. We have two break-evens. And if you look at the table, the lines I just filled in, with the stock at 56.20, we're even. We're making $3 on the call. We're losing $3 on the put. We're even. With the stock at 43.80, we're losing $3.20 on the call. We're making $3.20 on the put. We're even. But when I fill in the blanks, I'm going to fill everything in here, in the middle in particular, you see that with the stock at 50, which is our strike price, we lose $6.20. We lose $6.20. That's what we paid for the straddle. We can't lose any more than that. And if you look, I'll fill in the rest of the blanks. As the stock goes up, look at 60. We're making $3.80. You know, when it comes down to 40, we're making $3.80. We can't lose any more than that $6.20, and we only lose that with the stock at that strike price of 50. Look at 45 and 55. As the stock moves away from the strike price, either up or down, we make some money because either the call is going in the money or the put is going in the money. They both can't be in the money at expiration, one or the other. If the stock closes exactly at 50, we lose that 620. But as one or the other goes in the money, we get some of our money back. Now, we explain the two break-evens, and you can see how as it either goes up or goes down, one or the other goes in the money. And that's when we expect that big move in the stock. But one thing that can happen, and I'll put this other graph up and explain this, but one thing that can happen here before we get to that big move in the stock is we get that big increase in volatility. You know, a rumor comes out. There's something happening that's in the same industry but not necessarily with that stock. So a lot of people think something else is going to happen. So as news comes out, as rumors come out, as risk goes up, the cost, volatility goes up, the price of the options go up. So we may not need that big move in the stock. We may just need that big increase in the volatility. And if the volatility increases, both call and put price increases, and hopefully even if the stock doesn't increase the way we were looking for it to, the volatility increase will be enough to bring both prices up where we can make some money. So we're looking again for a big increase in the stock or a big increase in the volatility. Now take a look at the chart we have here. You see the two break-evens. You see that deep V right at 50. That's where we lose all of our money. We have two break-even points, and the most we can lose is the $6.20 debit. So it's maybe a little bit confusing with the long straddle, but you just have to remember that it's looking for a big move in the stock or looking for a big increase in volatility, and that's how you can make some money. The most you can lose, again, is at the strike price and what you paid for it, and as you move either higher or lower, you have an opportunity to get some of that money back. So you have a small chance of losing all of your capital, in this case the $6.20, because if we go to 51 or we go to 48 or 46, we can make some of that money back. So let's talk about the long strangle for a second. Take a look at the graph on the right-hand side. Now you see it has a flat bottom as opposed to the point that we had with the straddle. Just think about that for a second. And now we're going to talk about buying a call and buying a put, but this time we have different strike prices. We have a higher strike price for the call and a lower strike price for the put. Again, it's the same stock, the same expiration month. Again, we're looking for increasing volatility or a big move in the stock, and this has a lower cost than the straddle, and we'll talk about that in a couple of seconds. So here's our example. XYZ is trading at 50. We're going to buy the 55 call. That's going to cost us $1.40. We're going to buy the 45 put. That's going to cost us $1.05. That's a $2.45 debit. Now that's a $2.45 debit compared to a $6.20 debit for the long straddle, if you remember. Right? So it's a little bit cheaper. So it's $245 total. And again, we have two rights. We have the right to buy the stock at 55, and we have the right to sell the stock at 45. So again, two rights. Where do we think the stock is going to go? Right? So again, we're looking for a big increase in volatility. So we'll fill this table in again. There's your two break-even points. We'll put them in there. Again, two break-evens. We have a call and a put. a break even on the upside, a break even on the downside, two break evens. We're going to fill in the middle. Now, notice the middle here, the difference between the Strangle and the Straddle. With the Straddle, at 45, 50, and 55, we lose our entire cost. We lose our $2.45 debit. Right? That's between the strike prices, because at 45, 50, and 55, neither the call nor the put is in the money. Right? And think about what we did before. The 50, just above or below 50, something is moving in the money. Now at 45, 50, and 55, nothing is in the money. So we'll lose our $2.45. But if you go above, let's look at 60, go above that, we see we're making $2.55. And if we come down to $40 price for the stock, we see again that we're making $2.55. So this costs less. It costs $2.45 versus $6.20. We have a greater chance of losing all of our capital because we have losses at 45, 50, and 55, or anything in the middle between the strike prices versus just at the strike price. But we have profit potential again too. Once the stock goes up or goes down, we can make money. And again, to drive option prices up, we're hoping for an increase in volatility. So even if the stock doesn't get that big bump, maybe it gets a little bump in volatility, drives those prices up high enough that that the combined straddle we could sell for more than $2.45, we can make some money. So in the Strangle, we need less of an increase in the stock and maybe less of an increase in volatility, but we have that flat bottom where we can lose all of our capital. And you can look at that here on the graph. See that flat bottom again on the graph? Break even is 42.55 and 57.45. But everything in the middle, from 45 to 55, is where we lose all of our capital. So again, we're looking for an increase in volatility here, and we're looking for volatility to lift both the call price and the put price to the point where we can get back more than our debit of $2.45. So the Straddle versus the Strangle. Again, the Straddle has a higher cost, which means it has lower leverage. The break-even points are closer together, and you have less chance of 100% loss, because 100% loss is only at the strike price. Remember, it was $50 only at that strike price. Do we have 100% loss? With the Strangle, our lower cost means that we have higher leverage. We can buy more Straddles than we can Strangles, if you want to look at it that way. Our break-even points are further apart, so we need more of a move in the underlying stock, and we have a greater chance of 100% loss because we have that flat bottom. And anywhere between those two strike prices is where we can lose 100% of our capital. But both strategies require a big move in the underlying stock or a nice bump up in the volatility. And sometimes that bump in volatility will have more of an effect on the option prices than a move in the stock. And again, that's why in the option world, you have to be willing to pay attention. So you pay attention to the volatility. You see volatility changing, take a look at what your option prices are doing. Maybe we wanted to get out, we had an idea that we can spend $2.45 and maybe we can make $2, but maybe we're looking at volatility and it spiked up and that might be coming back down again. It may be time to get out of that trade. Pay attention to volatility as an indicator when to get out of these strategies. All right, the short straddle and the short strangle. So a short straddle is just the opposite of the long straddle. Like take a look at where the point is on our graph, right? See that point of the graph? That's where our big loss is our big profit is at that point right there. Now a short straddle and a short strangle, we're selling rather than buying. So we're selling a call and we're selling a put. When we sell a call and sell a put, we have two obligations. We have an obligation to sell the stock, and we have an obligation to buy the stock. And when you have an obligation to sell the stock, if you don't own that stock, you now have unlimited risk. Right, so that short straddle, the call side carries unlimited risk. A short put, we know, carries substantial risk because we can end up buying stock at a price that's declining. So we're short a put, we have an obligation to buy the stock, we get assigned, and the stock goes to zero, we have substantial risk. So a short straddle has substantial risk with the puts and unlimited risk with the calls, but it is a limited profit potential strategy. The most we can make is the premium that we bring in when we sell that straddle. Now, when we sell a straddle, if we're looking for an increase when we buy the straddle, we're looking for a decrease when we sell a straddle. So we're looking for a decrease in volatility when we sell a straddle. Decreasing volatility usually brings decreasing option prices. So if the volatility is decreasing, we expect the option prices to decrease. And if they decrease enough, we can buy them back for less than the credit that we brought in, we can make money. Now, if this stock stays where it is and doesn't move, stays around $40, we can make that entire premium. Because if you look at the graph, the stock had to come either down far enough to make money or to lose money, or up far enough to lose money. So we're looking again for, in this case, we're looking for no movement at all in the stock or very little movement, and we're looking for a decrease in volatility. And again, as I said before, rising volatilities rather bring rising option prices. Declining volatility brings declining option prices. This is where we're looking for a decrease in volatility with that short straddle. Now, the strangle, again, is the opposite. The short straddle is the opposite. The short strangle, rather, is the opposite of the long strangle. Look at that flat top, right? We have that flat top in there. And again, we're looking for a decrease in volatility to bring those prices down so we can buy it back cheaper. Now, this is the same concepts apply with the short straddle and strangle that apply with the long straddle and long strangle when it comes to the break evens and the profitability. Here, if stock stays between just the strike prices, we can make the entire premium. So we have a greater chance of making more of our premium than we have with the short straddle. Again, an increase in volatility will hurt this position. We want a decrease in volatility. We're looking for the stock to stay where it is or for volatility to decrease. If volatility decreases, hopefully the prices will be less than what we sold them for, and we'll be able to buy back our strangle and make money. All right, let's talk about backspreads. Backspreads are similar to vertical spreads. It involves a purchase and a sale of an option contract. It's either all calls or all puts, same stock or ETF. But unlike a vertical spread, we don't do the same number of contracts. Usually when we talk about vertical spreads, we talk about buying one and selling one, buying two and selling two. When we talk about backspreads, we talk about a ratio. The number that is bought is higher than the number that is sold. We tell you here the example is a 2-to-1 or a 3-to-2. I've seen them as a 3-to-1, a 4-to-1. It can be any ratio like that you like, but the buy side is always greater than the sell side. So you're always buying more contracts than you're selling. Right? You're always buying more contracts than you're selling when you do the backspread. All right, again, more long than short. And that more long than short, that limits our loss. And when you think about this, if you always have more long than you have short, you never have any uncovered calls or uncovered puts. And that's what we like. We like that risk to be defined for us. So for long more than we're short, we have defined risk. We can do backspreads for a credit, a debit, or even money. Anytime you can do something for a credit, that's preferable. Although when you do it for a credit, you'll probably have some margin that you have to put up at that time. That's going to be something that you'd have to talk to your broker about, how much money you have to put in when you do a backspread and you end up with a credit. And getting a debit or credit is going to depend on the option prices and the ratio, and the option prices are going to depend on the strike prices that you pick, as you do, in the money versus at and versus out of the monies. So backspreads, again, each short side is covered by the long side. So we tell you that it's a credit vertical spread and you have extra long options. There will be margin required here. Talk to your broker about what that's going to be. And if you think about it briefly, if you're long 2 and short 1, you have a spread when you combine the 1 to 1. And if that's a credit spread, the margin is usually the difference between the strike prices less any credit that you've brought in. So that's probably the margin that's going to be required on the spread side of it. The extra long would usually have to be paid in full. We tell you on the bottom here, a brokerage account must be approved. Now, your account has to be approved for option trading. Number one, you must know that if you're on this listening to this webinar. But anytime you do spreads, you have an increased requirement at your brokerage house. You'll have to approve probably that you have more capital in your account, that you have some option trading experience, and then you can come in and do spreads. But you're going to need approval to do these spreads. So the outlook on the stock could be bullish or bearish. If you're bullish, you do the call back spread. If you're bearish, you do the put back spread. Again, we're looking for a dramatic move in the underlying price. Up if you're bullish, down if you're bearish. And we tell you here, further expiration months, greater cost of the spread. So the further out you go, when you buy something, you pay for time, right? You pay for time. So if you're buying more than you're selling, that's going to increase the cost of that spread. We're also looking for an increase in implied volatility. Remember, we're long, let's say we're long 2 and short 1. So that increase in volatility will lift those 2 more than it will depress the 1 short 1. So we're looking for an increase in implied volatility here as well. So let's take a look at a call backspread. Again, we're going to buy 2 or more calls at a strike price and sell fewer calls at a lower strike price. So if we buy at a strike and sell at a lower strike, so we're actually creating a credit spread here. We're selling so let's say we sell the in the money, we buy the out of the money or the ats. We're creating that credit spread. The strike price is generally the long call is the out of the money. The short is either the in or the at. And the strike price, the greater the differential, the greater the risk of the spread. Now, think about this for a couple of seconds. The further out you go with your spreads, the wider the strike price, the spreads in the strike prices you use, the greater your risk. If you're long 30, you're long a 30 call, and you're short a 25 call, you can only lose $5, right? You can get called away at 25 and buy it back at 30. But if you're long the 25 and short the 35, you have a $10 increment between 10-point spread. So you have $10 at risk between the two. So the greater or the wider that spread, the greater the risk of that spread is. So when you do these, you have to be careful about that, paying attention to that spread, paying attention to that risk, understanding what you can do here. Now, sometimes it's tempting to buy that higher strike price because in the example I just gave, the 35 will cost less rather than the 30. It's further out of the money. So it'll cost less, so it seems like it might be a better spread because you think to yourself, well, if I could buy the 35 for 50 cents and the 30 for $1, I think I'd rather buy the 35 for 50 cents. But that might not be the better strategy because you have $10, between the two strike prices, you have greater risk than when you have $5 between the strike prices and have that lower risk. So again, the short call is covered by the long call. A credit spread, you have this credit spread on here when you do this, and you end up with the extra long calls. So you can break it down into 2 components, and that credit spread is a bear spread. The most you can make is the credit that you bring in, less any premium. The most you make is the credit that you bring in. Your risk is the difference between the strikes, less that credit that you bring in. But that extra long call has unlimited upside potential, right, above its break-even point. So when you do these, you hope the stock goes up a little bit. We want the stock to go up a little bit, but I think what we're really looking for here is that increase in volatility, because that increase in volatility will increase the 2 long calls prices greater than it will increase the 1 short call. So the 2 long calls will outdo the 1 short call. So when you look at this, the long call is paying for that short call. So you might be getting that spread, that credit spread, for almost free. But you got to be careful of thinking that way. There's no such thing as a free lunch. We all know that. And the decay in the short calls offset some of the decay in the long calls. So when you have time decay, we have 1 short position decaying and we have 2 long positions decaying. Now that 1 short call is not going to completely offset the 2 long calls, but it may help. It's certainly going to help a little bit. So the upside profit potential is unlimited because of the extra long calls, and that's going to depend on the number of calls. So if you did a 3-to-1 where you bought 3 and sold 1, you have 2 calls on the upside that have unlimited potential. If you do a 3-to-2, you'll have 1 that has unlimited upside potential. So you have to look at your ratio when you do this on the backspread. What are you doing here? And make sure you do the math and figure out that the risk and the reward, and look at how much money you can make if you're bullish and the stock goes up. Now, the downside loss, again, is limited. You have that spread. That one call is covered by the long call. So you have a spread, and we know spreads have limited risk, limited reward, so that spread helps you here. But the call spread is really a bullish position, and we expect that stock to rise above the long strike price. And the higher it goes, the better that one long call is going to do. Now, if we don't get a huge increase in the stock, we're looking for, again, an increase in the volatility. The increase in volatility will help bring those two calls up. It may bring that short call up, but the two will outweigh that one short call. So let's look at, here's a graph of what it looks like. Again, we sell one call, we buy two calls. And if you look at that graph, you see we got that flat line in the top. We tell you this is your risk here, and you look, we got the kind of the V with the spread, and then back up again with that long call. So when it comes down, the stock goes up and goes up. We're going to lose a little bit of money in the short call, and then that extra long call, the extra two long calls are going to kick in, and that's where we get that big increase. We have some good profitability here on that long call, unlimited profitability on the long call. Time decay is going to hurt this position because you're long two and you're short one, although you get a little bit of offset on the short one. Again, an increase in volatility is going to help because the increase in the volatility for the two will outweigh the increase in the volatility on the short one. Okay, so on the downside, if the stock closes at or below the strike price, all the calls will expire worthless and we'll lose money, right? All calls are worthless. If we did it for a credit, we get to keep the credit. If we did it for a debit, we're going to lose what we paid for the spread. So that's why it's always great if you could do these for a credit. But a lot of times it's hard to do them for a credit. It might be a very difficult thing to do. But again, if it expires worthless, the most you can lose if you do it for a debit is the debit. If you ended up doing it for a credit, you get to keep that credit. So we tell you here that the maximum loss, the stock rises and closes at the long strike price. Now, why do you have to understand this? If the stock goes up to the strike price, let's just say we're long the 50s and we're short the 45s. If the stock only goes to 50, right, just goes to 50, we get no benefit from the extra long. The extra long closes at the money, which means that it has no value, but the credit spread is in the money. We lose the difference between the strike prices, plus any debit that we may have paid or minus any credit that we may have brought in. So just getting to the long call strike price is not good for us. We need it to be above that long call strike price. And again, that's because if it just hits that strike price, that extra long call doesn't do us any good at expiration. Right? And we end up with a credit spread that's in the money, and we know that's a risk of the difference between the strikes, less any credit. In this case, it might be plus any debit if it costs us money to put on this backspread. So it's important to understand that the maximum loss is if we just get to the strike price. Once we get above that strike price, that's where we start making with the money with the long call, and that is what we're really looking for. Now, again, before expiration, we're looking for an increase in volatility. That increase in volatility will help us. The maximum loss calculation, it's difficult to figure out what the loss is. Sometimes depends on the ratios. If you're buying two and selling one, it's easier than if you're buying three and selling two. There's some math involved, and we won't go through the math, but take a look at optionseducation.org. We have some position simulator there which will help you understand how that math works. And it is the backspreads are complicated because of the ratio. I remember when I worked on a retail trading desk, and people would do backspreads. They would do the ratio. They would simply, if they were buying two and selling one, they'd enter the spread, the 1-to-1 spread as a spread, as say a $2 credit, and buy the extra one at the same price. Rather than going through the math and doing the calculations. It may be something that works for you to do it that way. If you're buying three and selling one, you do one spread, buy the extra two at the same price, if you're able to do that. Or you could just simply enter into your system, enter the 1-by-1 spread. If your system won't let you enter backspreads, you enter the 1-by-1 spread, and then enter your long calls at the price that you buy your call in the spread. Now that could be a little tricky because the markets move, as we all know. Or you have to call a desk. Maybe you can call a desk where you can enter an order like that over the phone. You'd have to see what your broker allows you to do. So here's our example. We're bullish on XYZ. We're looking for a rally within the next 60 days, and we're looking for the implied volatility, and I wouldn't say to maintain. I think we're looking for it to increase. So we're going to buy a 1 to 2 call backspread. We're going to do it for a small net credit. So again, the motivation is increased leverage on the upside with for profits. We have that extra call. That's what we're looking for. The trade-off here is that a modest or a slow rally can result in a loss. Look, if the stock doesn't move or volatility doesn't increase when we want it to, time decay is kicking in. It's going to hurt us as we go. A lot of times we need something to happen quickly when we do these type of trades. Realizing the loss can require an outlay of additional cash. If we have that loss, we have to buy back that short call. That short call is in the money. It may be worth more than the long calls are. It may cost us some additional cash to get out. The upside is break-even is higher compared to a simple call. Absolutely, it's higher because we have 2 long calls that we're trying to buy. So these spreads can be a little complicated. They're really not that hard if you sit and you think through them. And if you think through, I'm long a call, short a call, I'm long an extra call. I'm long 2 calls, short 2 calls, long an extra call. If you take each piece individually and work through the math, they're not as difficult to understand as they may appear. And again, volatility plays a big part in these. We have a ratio working here. That long side, for an increase, we want that increase in volatility. Bring those 2 up. All right, so here's our example again. Our time frame for the rally is 60 days. The stock is currently at $47. So we're going to sell a 45 call at $3.50, and we're going to buy 2 of the 50 calls for $1.25. That's going to cost us. That's going to give us a net credit of $1, right? Because we're selling 2 at $1.25. That's $2.50. We sold for 3. A net credit for the entire, 2 to 1 of $1. All right, so we're not going to do the math here because we'll be here till tomorrow morning to do all this math, but we'll fill a few things in. So we filled in some break-evens here. And you look at 54 as a break-even and 46 as a break-even, and you see that, we're not making any money. We have the offsets. Look at 54. Those short calls losing $5.50, but we're keeping the premium from 2 of the 50 calls. So we're keeping $5.50. I mean, we're keeping the premium of $5.50. Look down at 46. We're making $2.50 with the short call. We're losing $2.50 with the 2 long calls. We're even. But what I'm going to fill in the rest of the table, just to make life a little bit easier here. Look at the price of 50. That's where we lose the most money. At $4 is where we lose the most money that we have here. Now, come down to the $40 range. See, we're only making $1. What's happening now is we're short 145 call at $40. That 45 call is worthless. We keep the $3.50. The 250 calls are out of the money. We lose the 250 we paid. We make $1. The most we can make is that credit. But come up to 60. Look at the stock at 60. We're now losing $11.50 on the short 45 call, but the 2 long 50 calls are making. We have a profit of $17.50 on that, and that's because as the stock goes up now, we're increasing, 2 calls are increasing in price versus the 1 short call that's increasing in price. So that's going to ratchet up every time that goes up. We'll see a greater increase as that stock goes up. So if the stock goes down here, the most we lose is $1. If the stock goes up, we have unlimited profit potential because we have that extra long call. We have that extra long call, and that's what's going to help us there. Now, you could think about this, as the stock moves, but think about it as volatility increases. If volatility increases, we get twice the volatility increase with the 2 long calls as we get with the volatility increase with the 1 short call. So that offset, that volatility increase having an extra long call is going to help us here. So a problem we have here is early assignment, and that's a problem with a lot of option strategies that involve short calls. If you get called away before ex-dividend date, we have a problem because we get called away. We have two long calls. We can exercise 1 and buy the stock, and that's fine. If we exercise that 1 and buy the stock, we cover our short position, and now we have one long call. We're still bullish, and if the stock goes up, that's okay. But what we're trying to do here is avoid that. So if we think that assignment is going to happen, we have to buy back that short call. And we put the strategy on for a reason, and we don't want that assignment to come along and get in our way, right? That assignment's going to get in our way, what our idea was. And we always talk about having a plan in the option world. And if that does happen, if assignment does come along, you have to have a plan. Are you going to go out and buy the stock, or are you going to exercise? Or you have to plan ahead and say, the XYZ is paying a dividend on the 15th. It goes X on the 15th. It looks like I could be assigned here. I'm going to close this strategy. Well, you don't have to close the entire strategy. We tell you on the bottom that you must close the spread, buy one and sell two to avoid assignment. We don't have to do that. You can buy back just a short side. Now, if the stock has been increasing, buying back that short side, can be costly because it's probably worth more than what you sold it for. So you're going to buy that back. You're going to lose a little bit of money, but hopefully that sell side will offset any losses that you have when you buy back that short side. Now, you can close just the spread, just a one-to-one spread if you want. Maybe you'll make some money on that long side. You'll have a little bit of less of a loss on the spread, and you still have that one left to have as a unlimited upside profit potential. So you don't have to close the entire spread. You can just buy back the short side, or you can close the 1-to-1 ratio spread that we put on and leave the other long one alone. Don't have to do that. And that's part of the beauty of the options world, that there's so many different choices, so many different ways to approach a problem, and there's no one right answer. The answer depends, on every individual investor will have a different idea of how they want to approach something. But it's about planning in these situations. It's about a plan. What happens if I get close, if I think I'm going to be assigned? So a quick modest rally, attractive profit possible. So I think that when we look at things in the options world, we want a quick rally. We want that stock to go up. We want that volatility to increase. If it increases quickly, we can make money. And if I can invest some money today and make a profit in a week and get out and move on to something else, that's great. Why do I want to hold something till expiration? As you hold a strategy till expiration, you see what happens. Time decay hurts the long side, helps the short side. So in these backspreads, you have a situation where it's hurting that long side twice as much as it's helping the short side. So we don't want that time decay. Implied volatility, if volatility comes along and increases immediately, that's great. We can get to a place where we can make some money. We have our idea of how much we want to make. If we get there or we get close, maybe it's time to move on. We talked about a plan, having an idea. A volatility increase comes along. Maybe you look at that and say, hey, that increase is what I was looking for. Maybe not as great as what I wanted, but it's there now. Let me take the profit. Let me move on to something else. So quick, a modest rally. You could have a profit there. Pay attention. Again, it's part of the plan. So short straddles and short strangles, two places where we really have a lot of volatility. We talked briefly about these before, but what I want to stress here is that these have unlimited risk on the call side and substantial risk on the put side. Not something that the faint of heart should get involved in. They're a strategy that will work, but it's a strategy that a lot of people may want to think twice about before they get involved in. Ratio spreads, the opposite of backspreads. You sell more options than you buy. Again, if you sell two and you buy one, you have a spread. That's fine. That's limited risk, limited reward. But you do have that short or naked call or put out there that has substantial risk or unlimited risk, and that's the positions that you have to be careful with. So that's all we had prepared for today. That leaves us with about 10, 12 minutes for questions. I hope that you've learned something today, and if you didn't come away being an expert in straddles, strangles, backspreads or ratio spreads, I hope I've given you something to think about. You can take a look at OIC. We have some different channels here. We have a YouTube channel, we have a mobile app, and we have www.optionseducation.org, which are all great resources and something that you should absolutely look into if you want more information. So, Mark, I think it's let me see if we have any questions.
We do, Bill, and thank you very much. What fantastic information. As far as questions go, Bill, there's something that we get often at the investor services desk. For example, an investor will buy a straddle anticipating great earnings for company XYZ. They buy a straddle maybe a week prior to the earnings. The earnings are favorable, the stock goes up, and they lose money on the straddle. They can't understand why. How does volatility come into that play?
Well, Mark, that's it's a great question. It's a classic example of how volatility has a bigger effect on the option pricing than the actual underlying stock. In this situation, I would 90% of the time, it's going to be the fact that earnings were coming, volatility was high because risk was high, because nobody knew what the earnings were going to be like. There's a lot of rumors about the earnings. They're going to be good, they're going to be bad. Nobody really knows. So risk is up. So the prices are up. So we buy that straddle. We get the news comes out. It's great news. The price of the stock goes up. But you know what? The risk is gone. The risk is out. The news is there. There's no risk anymore. So the risk comes down. So the volatility comes in. So the prices come in. And the prices come in, that decline in prices because of volatility is more than enough to offset the increase in price of the call price that you would ordinarily see if the stock price goes up. So that's really a volatility, that's a volatility at work right there.
So that makes sense. Now, we just talked about backspreads. Why wouldn't an investor just buy a long call rather than buying two calls and selling one against it? Why not just buy a call outright?
Well, because if you buy a call, we buy a call, that's money out of our pocket. We can sell two calls and bring two calls in and pay for that call. Now, of course, we have to put margin up, so it's not free. It's not like I'm getting this call for free. We're putting margin in here, but we're looking for volatility to come down so those prices come down. So if I'm just buying a call, that means I have just a view, a straight-out view. I'm bullish. I think the stock is going up. If I do a spread, I have a slightly different view. I'm more moderate in my view. So maybe I don't think it's going straight up. Maybe I think it's going to hang around a price a little while, or only take a moderate move up or a moderate move down. So that spread is a little more moderate than the straight outright buy is.
I see. Now, looking at a straddle, for example, two questions really. Number one of the investors wants to know, speaking of earnings that we had just mentioned, how far ahead of earnings would you buy a straddle in order to take advantage of that and not be affected by that, the increase, that buildup of implied volatility prior to the earnings release, number one. And number two, how would you select which strikes for a strangle, for example? How would you suggest which strikes you would go ahead and place an order for?
All right, so let's start with the straddle one, and this is going to take some doing, and it's going to be a situation where you're an investor and you've been following a stock for a while, and earnings always comes out on the 15th. So you've been watching this for a while, and you see the buildup in volatility start happening 10 days before the earnings are coming out. And I'm not using 10 days. I'm telling you 10 days is the time frame. I'm saying it's different with every stock, and it's something that you have to pay attention to. So from watching the stock in the past, that the buildup in volatility comes 10, 12 days before the earnings come out. Excuse me. So you're going to have to, of course, be doing that straddle prior to that. Now, that's not an easy thing to pick. It's not an easy thing to pick. But you can go back and look at some historic volatility. Go to iVolatility.com or ImpliedVolatility.com and look at some volatility numbers and go back and see when the increase starts to happen and be ahead of when that happens. I know it doesn't sound like a great answer, but it's really the answer that I have, that you have to be ahead of that, and it's not an easy thing to predict. Now, the second one was the straddle. How wide would you do these straddles? Well, that's, again, dependent on what you think the stock is going to do. If you watch the stock in the past and it trades in that tight range and you want to buy something, well, you don't want to do that straddle with a wide range because it's never going to get outside those two strike prices. You want to narrow that. If it trades in a narrow range, maybe you want to go, maybe you're okay going out a little bit. Again, it's going to depend on the stock, the history of the stock, and what you've seen in the past.
Okay, that makes sense. Now, here's something with, somewhat political with the with the election on the horizon, how can an investor or how is volatility going to and the uncertainty going to affect the market with the election or a Fed announcement, for example?
Well, Mark, if I knew the answer to that one, I'd be on CNBC every night at 5 o'clock. I just know from all the years that I've been in the business that as the election gets closer, volatility increases. And there's a lot of people out there, be a Trump fan or be a Clinton fan. There's a lot of people out there who are very tied to their candidate, if you will. So I think that you'll see volatility increase as we get closer and closer to the election. And if you're thinking that volatility is going to increase as you get close to the election and will come back down to, historic norms afterwards, you might want to try and pick the top, which is another very dangerous thing to do. Sell something and let volatility come back down again and buy it back. But again, that's something that I think I would leave up to the professionals.
Well, that sounds good. Bill, let me ask this. We had one of our investors, one of our attendees, asking about LEAPS options and how would volatility affect LEAPS options?
All right, so how volatility affects LEAPS options, and it's a very difficult thing because if you're taking on the risk, so you're the short side, you're assuming the risk, and we're going to take a leap. We're in 2016. Let's take a leap in September, October. We're going to have 2018s coming out. So I have to price a 2018 leap. I have to predict volatility for 2 years. That's a very difficult thing to do. So predicting volatility for 2 years is hard. So that's going to affect the price of my leap. So I'm going to look at volatility over a period of time. I'm going to build in a cushion, and I'm going to raise the volatility up because I want to sell that option at as high a price as I can to assume that risk for the next 2 years. And I like leaps. I think leaps are a great tool in certain places, but they're very expensive. They're difficult to price, and if you're the guy that's taking the risk on the sell side, you're going to want to build in enough cushion to accept that risk. So volatility plays a big part there. And remember, you're predicting, stock movement, you're predicting interest rates, you're predicting dividends, and you're predicting 2 years worth of volatility.
So you need a very big crystal ball, you're saying.
A very clear crystal ball, I would say.
Right. Speaking of, selling options, we were talking about buying straddles prior to earnings announcements. What about selling straddles ahead of earnings announcements? Because, it does seem sometime that there's that implied volatility crush where things don't work out exactly as we had planned and the market actually volatility comes in. So what would you talk about, selling straddles and selling spreads prior to volatility? Certainly is a great amount of risk, right?
Well, before the earnings come out is when the volatility is the highest because we don't know what the earnings are going to be. So there's higher risk, higher volatility, higher prices. Now, if the earnings goes up, and again depending on the stock, let's pick a utility stock. How high are the earnings? Is the volatility going to be on the utility stock? Probably not as high as on a pharmaceutical stock or a technology stock. So there's going to depend on the stock. What you'll have to make sure is that you bring in enough premium to cover the amount of risk that you're assuming. Remember, a short straddle or a short strangle involves a short call, which is unlimited risk to the upside and substantial risk to the downside. You're going to have to put up margin. There's no doubt about it. So the premium that you bring in better be worth the aggravation that you're going to have and better be worth the sleepless nights that you're going to have having both those risks.
Okay, well, that makes sense. We were talking about strangles versus straddles. A straddle, obviously, as you know, if you look on the P&L graph, a straddle is a V, whereas a strangle is a V with kind of a flat bottom. One of our attendees is asking if you can elaborate a little bit more on the difference between strangles versus straddles.
Okay, so let's do the straddle first, and remember that V, right? That V is where you can make money, right, at the strike price. And if you look at the strangle, when you have that flat bottom, the V is where you could lose the most money on the long straddle. You lose the most there at that strike price. With the strangle, you can lose money on that flat bottom. And that's because with the straddle, that deep V, that V is your strike price. And if the stock moves up, the call goes in the money. If the stock moves down, the call goes in the money. So if it goes from 50.01, to 50.02, you're making money because the straddle has to make money as the call goes up or as the stock goes down, the put goes up in price. The strangle, we have the flat bottom, and those, in that flat bottom, those strike prices in the middle is where neither the call nor the put is in the money. So with a straddle, one or the other will be in the money at expiration, but with a strangle, that's not necessarily so.
Okay. Well, thank you for that. And Bill, unfortunately, we've run out of time. We still do have plenty of questions. So, ladies and gentlemen, what I would like to suggest is our investor services desk will be replying and responding to your questions later, most likely tomorrow. In the meantime, you can contact them at options@theocc.com for further assistance. Also, regarding the PDF version today, if you would like a copy of the PDF version of today's presentation, you can also reach out to Investor Services. Again, the email address is options@theocc.com. And additionally, many of our other webinars are available for viewing on the OIC YouTube channel. And lastly, many of you inquired about further options education. As Bill had mentioned, please visit our optionseducation.org website. You can visit the Getting Started section for additional reading and additional options education resources. Thank you again for joining us, ladies and gentlemen, and have a wonderful evening.